Okay, welcome back. Our next panel is bread and butter of SEC enforcement, financial disclosure and accounting fraud. And our moderator is Marty Wilczynski, who's a senior managing director at Ankura. Marty has more than 35 years of professional experience in accounting, internal, and forensic investigations as a consultant at an international accounting firm, and also 6 years on the staff of the SEC, where he was in the enforcement division. Marty's past experience includes more than 7 years as co-leader of a consulting team providing investigative and litigation support in the Madoff liquidation. Very broad range of experience from Marty and a perfect person to moderate this panel. Marty, welcome.
Thanks, Bruce.
Let me next introduce Rob Cohen, who just a few years ago was the keynote speaker here at this conference when he led the SEC cyber unit. Before that, Rob was the co-chief of the SEC's market abuse unit. And now Rob is a partner at Davis Polk, where he focuses on representing companies and boards and individuals in regulatory matters, internal investigations, and of course, financial and accounting matters. And very fortunate and always great to see Rob with us here today. Welcome, Rob.
Great. Thanks, Bruce. Great seeing you.
And our next panelist is Howard Scheck. He and I go back to the 90s, and pretty sure we had offices next to each other, but are pretty close in the SEC's enforcement division in DC. Howard was one of the few enforcement lawyers who was also an accountant, a very powerful combination and one I wish I had on many occasions. But Howard went on to become the enforcement division's chief accountant. He's now a forensic accounting specialist and a partner with StoneTurn. Welcome, Howard. It's always great to see you.
Thank you, Bruce. Nice to see everybody.
And finally, Diana Tani, Assistant Regional Director in the LA office of the SEC. She's a member of the Enforcement Division's Market Abuse Unit and the Cyber Unit. Diana, our events always benefit from having your experience. It's great to see you. Can't wait to hear your insights today. Welcome.
Hi, Bruce. Thank you for having me. Great to be here.
Okay, Marty, it's all yours.
Great. Thanks, Bruce, and thanks, everyone. So 2020 was kind of an unusual year for the SEC and for all of us, really. And in the accounting and disclosure space, it was no different. But I think with respect to this panel and to kick it off, the one observation that I would have is that the accounting function, the Chief Accountant Commission of the Commission with Matt Jakes and his team really did, I think, a great job in keeping the ball rolling and processing through a number of cases. He had a few matters that involved testimony. The staff was always well prepared. It was a lot more seamless and smooth than I think anyone had ever expected it to be. And so the fact that there was, even though the numbers overall were down a little bit, there was a real productive year, I think, of different matters that went right through, and testimony ran and discussions were had, and everything went in a pretty normal fashion, which is a credit to the staff. Diana had a front row seat for a lot of the cases that have been brought and processed through. And we'll start our panel today by having Diana walk through some of them, give us a little bit of flavor for the numbers and types of different matters that the staff had brought in the past year. So Diana, you can take it away from here.
Sure. Thank you, Marty. And before I start, as many of you have heard today at this conference, the views expressed today are my own and do not necessarily reflect those of the commission, individual commissioners, or my colleagues on the staff. And also, when I refer to particular actions or cases today, I'm referring to the allegations in the complaint or the public order or the press release, and I'm not implying that any of the facts therein have been proven or admitted. So with that, I think the way to think about the accounting and disclosure matters that we've seen in the past year, they fall into what most of you are familiar with. There's disclosure types of cases, financial reporting, improper accounting, and then the third category I would put into that is the non-GAAP, non-financial metrics. And one of the examples of the disclosure violations was the General Electric case that the commission announced in December, where there were disclosure failures in two key business segments of the company, the power and insurance. And so in that matter, GE settled to fraud charges, anti-fraud, books and records, control provisions, and paid a penalty of $200 million along with certain undertakings. Some of the financial reporting, this is, again, what the SEC Enforcement Division has always investigated. We had the false revenue in the Luckin Coffee matter. Again, a December case, the company was charged with intentionally fabricating more than $300 million in retail sales. Luckin settled to the anti-fraud reporting, books and records, internal control provisions, and agreed to pay a $180 million penalty. And I think what was notably about Luckin, after the misconduct was discovered in the course of an internal audit, the company self-reported and cooperated with the staff. Then,
Diana, sorry to interrupt, but I'll gratuitously point out that they had, very experienced counsel on that matter, who may or may not have been Davis Polk. And that's public.
And overstated inventory, another revenue recognition matter, Manitex, back in September. It was a settled cease and desist proceeding and former COO and officers. And the company, again, settled to anti-fraud, reporting, books and records, internal control violations. There were also penalties, Officer Director Barr's Rule 102E proceedings. And again, two aspects of the financial fraud: overstatement of inventory and bill and hold revenue transactions. So that's the typical accounting fraud many of you have worked on, seen. And then the other area in terms of accounting fraud was the impairments cases. So we had the goodwill impairment of Sequential Brands in December, and also in December, a trademark impairment case involving Apex, formerly known as Cherokee. And those were settled as well. And then moving to the non-GAAP, non-financial metrics, we had in September, the SEC charged BMW and two of its subsidiaries for false and inaccurate disclosures about the retail sales volume. And again, this is another, you might want to take a look at this order, because the order notes particularly the BMW's significant cooperation during the investigation amid the challenges posed by the pandemic and travel restrictions, work from home orders. And the commission notes in the order that this cooperation was taking into account in imposing a penalty. And we have a couple of other non-GAAP matters. In September, we have BGC Partners, where we also charged Rule 100B of Reg G, which relates to non-GAAP. And of course, our office in Los Angeles brought the Valiant Pharmaceuticals matter last July. That also involved some improper revenue, as well as disclosures as to GAAP and non-GAAP metrics, such as same-store sales, organic growth.
Couple comments, Diana. I just thought get your perspective or the other panelists' perspective. It seems like notwithstanding Luckin and Manitex, which were more like intentional, kind of old-fashioned accounting, cases, seems like the commission is aggressively going after disclosure cases, particularly in the earnings management area, and then even when there are no accounting violations, the MD&A hook on the trends, and I assume that trend's going to go forward, and that the commission and the staff are going to keep going after those kinds of cases.
So I think that's something we in addition to the financial statements and the notes to the financial statements, the MD&A is a critical part of the disclosure documents and the company's filings. And so we're always going to take a look at what the company's disclosing. In Valiant as well, there were earnings releases that were attached to Forms 8K. There were PowerPoint presentations that the company used in its earnings calls. So that was part of the disclosures made to the public. And so we're going to take a look at all of what investors are being told.
Yeah, interesting. I mean, we all know that, from being on the staff and from looking at the cases, like when the commission can't find an accounting error, they're going to pivot to a disclosure and controls violations potentially. But it's definitely looking at the MD&A and looking at some of the cases on the pull-in revenue and really looking at the qualitative materiality and the trends. And it just seems to be a number of cases that I've worked on. I know Marty and Rob have worked on that are in that area.
Yeah, Howard, it's a good point. I'm also sort of on the lookout for cases where the connection to a filing is not so, dramatic. Certainly it'll be there, but even beyond an MD&A discussion, there's cases, and I think the BMW case Diana mentioned might be an example where, if you read the order, SEC filings do not play a prominent role. There's a discussion of, promotions the companies are making outside the filing. There may be, references or things incorporated by reference in registration statements for offerings, for example. But, I think you're completely right, Howard. And I think it potentially goes a step further. And I think this is something to continue to keep an eye on, not just what I'll call non-GAAP metrics, that may be in the MD&A, but other metrics that are used in promotions generally, press releases and maybe investor conferences that are not, dominant parts of the MD&A. I mean, there's probably going to be a connection somehow to an SEC filing, but it seems that having, a clear statement in SEC filing is not always going to be present in a case.
Yeah, like one example is the GE case. I mean, I found it interesting that like one of the allegations in that case involved a disclosure about the fact that the changes in estimates they were making in their estimates were not disclosed, even though it looked like from at least the description in the order that the process was pretty typical and that it didn't violate GAAP, yet it was the fact that the change wasn't disclosed, that the change in practice wasn't disclosed. So to me, it looks like, if you represent a public company or you work at one, really looking at what changes in the practice and methodology might have been made. How does that impact qualitative materiality? And if you're not doing that assessment, you could be at risk. So, I mean, we're advising our clients to look at their past practices and their current practices to see, what controls they have in place to monitor those types of things and even assess that.
Howard and Rob, with respect to materiality, Howard just mentioned qualitative. Have you seen or been consulted on matters where, quantitative and qualitative materiality have kind of been at the front of the matter?
I have, but I'll let Rob answer first if you want to go, Rob.
Oh, sure. Thanks, Howard. Yeah, I mean, so we certainly have. I think that, sometimes it feels like materiality, as much as any other element of an SEC claim, is judged in hindsight. And so it's very hard to advocate a position in the investigative stage. Might be different if you were to litigate, but certainly in the investigative stage, I think it's the right way to look at it, but it can be hard to get traction on the idea that the way to look at materiality is on, at the time the decision was made, at the time the filing was made, based on the information that was available then. And it can just be a very hard, issue to overcome when interacting, with the staff during an investigation, because you will always have that conversation with the benefit of hindsight. Sort of by definition, you're having the conversation after things played out. And, if you could put yourself, in the shoes of the person making the decision at the time, sometimes things turn out one way, sometimes they turn out another way. Well, when there isn't much a reaction, right, there's no investigation. You only have the investigation when it turns out there was some kind of reaction. And it's not, it's sort of like not a fair sample size, I would say, because, before there's a reaction, you need to go back to the point in time the person was making the decision. So Marty, I mean, the answer is yes. I mean, materiality is important in all these cases. I find that it's one of the harder issues to engage with the staff on during these cases.
And Howard, you had a comment also?
Yeah, Marty, I think I'm predominantly seeing cases that involve qualitative materiality. And certainly we're seeing things that have normal quantitative materiality, the magnitude and the size, but all these earnings management cases, the rounding issues, the quarter end closing adjustments to close the gap, they're all sort of hinged on, whether estimates are met, whether, what the market is expecting for those things. And even in cases where there might be a restatement, you might look at the restatement. The restatement actually looks like it's quantitatively immaterial. You can question, was it really necessary to restate? Could be a fair question, but the companies restate. You look at the quantitative differences; they're not that different, and the staff's investigating and they're looking at the qualitative aspects. So it really is that's what I'm seeing predominantly is the qualitative.
Yeah, and I'd agree with both of those views. It seems to me, and we've come across a couple matters where there's always a materiality assessment in all of these cases. More often than not, quantitative materiality is what's driving the matter. But we've seen a handful of instances in the past year, and maybe it's because of the EPS initiative. And maybe it's just a broader view of the body of the evidence in any given matter, but the attention that the staff has paid to qualitative issues, and especially how those intersect with movements in stock price or what the quantitative factors look like. It's an area that I think boards and CFOs ought to keep an eye on, because like everything else, it's almost like in FCPA cases where there's misconduct. It's de minimis with respect to the effect on the financial statements, but if the conduct is questionable or problematic, then the materiality, quantitative and qualitative, both gets a lot tighter. So it's an interesting area, and that might be a segue in to the use of the SEC with its data analytics and how that's impacting and driving a few parts of the fraud and enforcement program. I know, Diana, you mentioned some EPS and executive perks cases. I think Howard and Rob both have had some experience in that area as well. Any particular cases that you want to highlight on the front end here?
Yeah, sure. Let me explain for some people who may not be aware of, in the area of financial reporting, financial fraud, the data analytics that the division has been implementing. So back in September, one of them is the EPS initiative. And so back in September, the division announced that it was going to undertake a risk-based data analytics program that was designed in-house, that was trying to focus on identifying and uncovering earnings management practices, both from an accounting and a disclosure perspective. So the idea is to try and find the outliers or the patterns of reporting of quarterly EPS metrics that might be suggestive of earnings management. And so there, things that might be considered are accounting adjustments that typically occur at quarter end when the company is not subject to a full year-end audit, where the accounts that are impacted are often discretionary and involve judgment. And the adjustments and entries are highly material, as what the panels are talking about, that these adjustments might be highly material to meeting or beating EPS, often to the penny. And so in September, we announced a couple of cases under this initiative, the Interface and Fulton Financial Matters. And Interface was an issuer based in Georgia. Again, it's a settled matter. The company and individual settled. And the order finds that in multiple quarters in 2015 and 2016 that the company made unsupported manual accounting adjustments that were not compliant with GAAP. And the adjustments were often made when the company's internal forecasts were reflecting that the company would likely fall short of analyst consensus estimates. And the adjustments ended up boosting the company's income, making it possible for the company to consistently report earnings that met or exceeded consensus. And then there was also, as I mentioned, the Fulton Financial Corporation, a financial services company based in Pennsylvania. Again, it's a settled matter. And the order finds that the company inaccurately presented its financial performance. And so what happened with Fulton is the valuation allowance for certain mortgage servicing rights was at odds with what the company described in its filings was a methodology that they were using. And what was going on at Fulton is the company was reversing this valuation allowance in order to increase its earnings per share by a penny in a quarter when it otherwise would have fallen short. So that's the EPS initiative. There's the other initiative with this data analytics is in the area of executive perks. And there have been, I think, 3 actions from that. One of them was Hilton Worldwide Holdings, the September 2020 settlement, where the company failed to fully and accurately disclose in its proxy filings that over $1 million in travel-related perks were provided to its executive officers. And so the order found that Hilton failed to apply the SEC's compensation disclosure rules. And then in June 2020, Argo Group International Holdings, a similar failure there. Argo failed to fully and accurately disclose over $5 million in perks paid to the former CEO. And it averages out to over $1 million per year where the CEO's compensation was understated. And then back in September again, RCI Hospitality, similar situation, the company failed to disclose a total of $615,000 in perks were provided to its executives over a multi-year period.
And Diana, it looked like from looking at the perks cases that clearly if you're a public company and your officers are using aircraft, you better have a way to track the use of the aircraft and make sure there's some controls in place for that, because I think all 3 cases involved aircraft issues. The other quick observation is on, the Under Armour case. I don't know, it doesn't sound like that may have been part of the EPS initiative, but it was another example of a pull-in disclosure case. And I guess one observation that I've had from looking at a few of these cases is that, and working on them, is that the SEC appears to have the idea that revenue is destined for a particular quarter. And if the company engages in any kind of practice that, even if they go to the customer and get consent to get, to ship something early, somehow that's automatically bad. And I guess from my perspective, obviously there's issues if trends are, material trends are being impacted, but I'm finding it like relatively typical that it seems like that, like a normal practice the company would engage in, is considered bad, and that there is like some destiny for particular revenue. I don't know if others have comments on that, but it looks that way to me.
Yeah,
Howard,
no,
my comment, Howard, is that when you were at the SEC, I'm sure you looked at it one way, and now that you're sitting at StoneTurn, you're looking at it like a good defense advocate for your client. But I agree. This is really, it's scary on the one hand and refreshing on the other that these same cases and these same types of issues have been under the microscope and getting attention by the SEC staff from back when we were all on the staff years and years ago, and still today. And the CPS initiative is a perfect example. There's a lot of activity. The data sophistication, as Diana points out, is really a game changer. By being able to kind of make a quick and sophisticated pass through of the actual reported numbers in EPS and analyst projections and all those things, really kind of give the staff the ability to focus on things that look potentially like low-hanging fruit. So it's an interesting time. I remember back in the 2006 or 7 period, all those stock option backdating cases, those principally came out of a bunch of research that was well done and targeted and identified in a pretty effective way. Lots of instances of companies that engaged in what looked to be backdating of stock options, and that proved to be a kind of a cottage industry for a couple of years. So where the SEC is, I think, on data is really an important way that they become more efficient and been able to kind of focus on matters that are a little more likely to bear fruit once they look into it. Rob, did you have a follow on?
No, sure. Just a couple of comments on the EPS initiative. So first of all, I mean, I think it's one of the more important initiatives you've seen out of the commission lately. The impact the cases have had and the attention that they get in the industry, I think, is really significant. When I talk to clients about those cases, sort of two things, are really grab them. One is, the really small size of a lot of the, entries that are at issue. In a lot of these cases, you're talking about, 2 or 3, reserve decisions where there could have been a reserve taken at the beginning of the year. And with each quarter, you adjust the reserve based on, what where the company thinks they're going to land at the end of the year. And some of these adjustments are, a couple $100,000 for a multi-billion-dollar business. And, the staff's theory is pretty clear. You take 2 or 3 of those and you put those together, it adds up to, maybe $750,000 or something like that. And you just follow the math and it leads to, a change in the EPS because you hit, if you're at 0.4, you get to 0.5 and then you round up. And then that's what you need to do to meet expectations. So the staff's theory on that is pretty clear. But when I talk to clients about it, it really strikes them how big of a case, with individual liability, people are losing their jobs. It flows from, a $200,000, let's say you have $1 million reserve and after a quarter you release $200,000 of it. And you still have a large reserve, but you've released $200,000. It's really, stunning in a sense for people who are dealing with that type of decision day to day, and usually on a much bigger magnitude, to have an SEC enforcement case come out of that. And I think, you could easily understand, what the staff, what the commission staff would say about that, which is these reserve decisions are very subjective. And, whereas the company would say, well, how can you tell me it was wrong? It's so subjective. The staff would say, well, that's what makes it right for abuse, right? That's why it's so easy to make a change. Anyway, and then the other thing I'll just say about the EPS cases, and Marty, you mentioned, the research that led to the stock option backdating case. It was very widely reported that the EPS initiative originated with an academic study that, studied the data and found a pattern that suggested to the authors of the study that there may have been rounding up. if you can, like the example I used, if you can get to 0.4 and if you're at 0.4 and you can get that to 0.5, then you can round up. The statistical, array of data suggested to them at least that was happening. So I think it's another, again, I don't think the commission has sort of said that publicly, but it was very widely reported at the time. And I think we all expect that there's going to be more cases from that initiative still to come this year.
The one thing I would add, I think those are really good points, Rob. And that's why documentation is so important for these small adjustments. And that, so I think the staff's position, it's one thing if it's subjective. It's another thing if it's subjective, it looks like it's going to meet a target and there's no documentation or support for it. So I think that's where we're seeing the companies sort of getting into troubles when there's no, there's really no support. So obviously what we're advising is really good documentation for those adjustments and being aware that the staff is looking at those kinds of things. So when you are making those subjective decisions or changing your policy or methodology or approach, that is fully disclosed and that it's, the auditors know about it if it's an issue and that it's not, it's transparent, basically.
Yeah, the only thing, I'm sorry, go ahead.
Yeah, I was going to say, and to follow up on what Howard's point is, it shouldn't be lost in several of the cases that I mentioned. The company was doing something that was at odds with the disclosed policy. And the several of the cases, there wasn't substantiation for what they were doing. So there were issues there, and that shouldn't be lost on people.
Yeah, and what I was going to say kind of dovetails with that, which is, on a lot of these matters, because they're made up of a handful of adjustments, one of the things that's critical is looking to see whether there was some sort of unified approach or proactive intent on behalf of management. Sometimes these underlying adjustments, are made in different parts of the firm or company. They get rolled up sort of anonymously, and by happenstance, you may come up to the same answer, which is EPS bumped up by a penny or down by a penny. But the trick or the challenge, I think, for the commission staff is to try to show in those cases where there's a movement or an effect, that there was actually some sort of intention to get to a number, above and beyond the normal, calling balls and strikes that different divisions do in a company that then get rolled up and consolidated, later on in the consolidation process. So we'll keep an eye on all of that. Another area that is interesting, and it'll be interesting to see how it pans out, is the ESG area and sort of particularly the enforcement initiatives that are out in the press and sort of being discussed and pursued a bit. Rob, do you have any perspective or discussions to offer up on the ESG and how that might shape up for the coming year?
Yeah, most certainly. I mean, I think ESG, especially in this area, but really as part of the enforcement program as a whole, is at the top of the list of what we're looking to see, in the bar. Let me say in the first year of the new administration. I'm sure most, if not all, of this audience knows that in March, the SEC announced a climate and ESG task force solely within the enforcement division, and went so far as announced that there were 22 members of that task force. I think as far as I can remember, I'm sure it's not perfect, but my recollection is when new units were formed or whatnot, and I remember this when we formed the cyber unit, we generally did not announce the size. We didn't announce sort of internal personnel or staffing aspects of it. So it really stood out to me, and I sort of took it as a message that there was this announcement about how big the task force was. It said, the announcement said it was going to proactively search for misconduct a very forward-leaning, posture as described in the announcement. The announcement said that they were going to use data analysis, just like we've been talking about. So it just seems like an expanded effort to use that kind of tool. And the issues that the press release said were going to be the focus were, issuer statements about climate risk issues and whether there's gaps there. And then also, disclosures and compliance issues for investment advisors who say they have ESG strategies. So I think, first of all, it'll just be fascinating to see, what comes from the task force and the resources that are being put into it. It's very clearly a high priority. It was announced under acting chair, Allison Lee. I think the general assumption is that, that the new administration would be supporting that, new leadership that would be supporting that. But, that's obviously something we're paying attention to. I think on the substance, and Marty, you asked me about, materiality earlier. I think that's maybe the most important substantive issue is materiality. And, now Chairman, Gensler was asked about this in his confirmation hearing. And he acknowledged that, things that can have a financially insignificant impact on the bottom line, generally are not considered material. But he also, I think, previewed an argument that we've started to hear, and that I think we can expect to hear more, which is he said he may be guided by the investor community. So in a sense, it sounds like, the position may be that regardless of the financial impact that, climate change may have on a company, if investors want to hear about it, the staff may take the position that that means it's material. And it'll be really interesting to see how that plays out. And of course, if you've been following this, you saw that two of the commissioners sort of issued a public, let me say, skepticism about this, because there was also an announcement that the 2010 guidance on climate disclosures was going to be revisited. And Commissioners Peirce and Roisman said, well, if we're revisiting that guidance, shouldn't we wait and see, what our conclusions are about that guidance before we start bringing, enforcement cases? So, very prominent issue at the beginning, of the tenure of the new leadership. And that's one of the key issues I think we'll be watching.
Yeah, I think that's really, really insightful. And one of the things that I thought about as this was developing here in the last few months is that it looks really clear that there will be additional rulemaking. It looks like there probably will be additional guidance from Corp Fin and from other parts of the commission. And so watching kind of an enforcement strategy develop in an area that at least traditionally has not been a hotbed of fraud or enforcement activity, watching that develop while the sausage of the rulemaking is getting put together. It'll be interesting to see what kinds of cases get brought and what the metrics are, because the rulemaking suggests there's a number of issues that are going to be challenging. The cost of the disclosures versus the cost of not having them, and principles versus metrics, or global comparability. A lot of companies who are global have operations all over the world. The climate requirements in different parts of the world are obviously different, and so how all of that will get amalgamated into the guidance is going to be interesting. Diane or Howard, any follow on to issues in this area?
So I think it's continue to pay attention is what I would say. And if you're, as part of paying attention, Chairman Gensler did testify last week before the House Financial Services Committee, and some of the questions that were referred to did come up. So I would commend people to check out his testimony and continue to see what comes out from the SEC.
Yeah, I don't really have any other points, Marty, other than, obviously our clients would prefer not to have regulation by enforcement and have clear rules as to what is actually a violation, especially in this area.
Right. One One other area, we only have a few minutes left here. One other area that we haven't touched on is Reg FD and consequences. There've been a couple of matters that have kind of emerged during the year on that. Rob, any comments on that subject?
It's what's been interesting to me about Reg FD is, since I left the commission in 2019 and have been at private practice, it's really struck me how many questions I get about Reg FD, and why that's been so interesting to me is there's not a lot of Reg FD enforcement cases. There's certainly some, but not a lot compared to revenue recognition or non-GAAP disclosures or things like that. But what I appreciate now more than I think I did when I was on the staff is how much it is a very live and difficult day-to-day issue, right? So giving guidance internally and understanding where to draw the lines, and what's material, what's not material, when referring to prior guidance could be considered material, even if you're just reaffirming prior guidance. Even if you're not reaffirming it, but you're saying something that could be interpreted as reaffirming it. The Reg FD is an issue that every public company, grapples with, and there aren't bright lines, and it's hard. And so what's particularly interesting and is going to be important to watch is, the commission filed a litigated Reg FD case earlier this year that seems like it's going to be, hotly contested. It was a Reg FD case against AT&T. And, without going into the allegations of the case, anybody could look them up. But, the commission alleged that, that the company, thought that analyst expectations on a certain metric weren't right and made a bunch of phone calls to basically talk the analysts down, which it seems that they did. AT&T put out a very strong statement after the case was filed saying that this was something that the company it was a trend the company had disclosed many times. It was an industry-wide trend that was reported on throughout, the press. And therefore there was nothing, material about the information the company had because it was so well known, not just for AT&T, but for the company. So you could really see, the positions hardening on both sides, and, the commission doesn't litigate often against issuers. And, in the FD area, Diana and Howard and I and Marty, we were talking before, the SEC litigated a Reg FD case in 2004 and 2005 and lost. And, it, arguably had an impact over, the enforcement program for Reg FD. And it'll be really interesting to see, what the results of this litigation, are, because it's a tough area and it's so rarely litigated, and it's something that every company deals with day to day.
All right. Thanks for that. We're just about at the end of the session here. There was one question that popped in regarding whistleblowers and the numbers of whistleblower complaints that have to do with financial reporting and disclosures. And Diana, I know this is kind of an unfair question because the way the process works, and I think the way those whistleblower complaints get culled out is a little bit of a secret sauce in and of itself. But from your perspective, do you get insight into the ways that the large number of financial fraud type tips that the commission gets, what sorts of factors are considered, with respect to opening an inquiry or trying to, look to see whether there's, something behind the allegation?
So I know there's a whistleblower panel this afternoon that gets into a lot more detail. And then, so I'll start with that if people really want to focus on the issue. And then kind of going into the 30,000 level, in terms of the tips, complaints, referrals we get, in the past year, it's just skyrocketed. So I don't know. I was reading something that in 2020, we got 23,000, I think, whereas the prior year was maybe 16,000. So there's a lot that from that volume before it hits, how it gets how all those get processed, triaged, evaluated before it goes to a team to decide whether the matter should be opened or not. There's a lot of steps in that process. So it's hard to answer that question meaningfully because there's a lot that goes into that.
That all makes sense. I think the spike, I think, is everyone's at home. They got time on their hands. They're looking for a bounty, looking for a lottery payday. But anyhow, thanks very much to the panel. I'll turn it back to you, Bruce. I think.
Thanks, Marty. Terrific job as always on a really important topic. And Rob, Howard, Diana, thank you so much.